Okay, the bell is rung. It is Thursday, January 29th, 2026, and the final print is on the board. The S&P 500, it edged up just 0.12%. The Nasdaq climbed a little more, about 0.25%, 0.25. And the Dow Jones actually shed a fraction, down 0.10%.
Which is the most polite way of saying we just sat through a classic, absolute choppy mess.
It felt like watching paint dry in a wind tunnel. The price action was just glued to that flat line.
Because nobody wanted to make a move? Or, more accurately, nobody could make a move. We're in a very specific standoff right now. It's a deadlock.
A deadlock between what?
You've got, decent micro earnings on one side. Companies are doing okay, which is keeping a floor under things. But on the other side, you have this massive cloud of macro uncertainty, so institutional conviction.
Nowhere to be found.
It's parked on the sidelines. Completely.
So let's unpack that. Why the hesitation? What is the narrative driving this whole wait-and-see game?
It's the collision of two huge forces. I'm calling it the Fed hangover meets Apple Eve.
Apple Eve. That sounds almost biblical for the markets.
It feels that way if you're a portfolio manager, believe me. Look, yesterday we got the FOMC.
The dovish pause.
The dovish cause, exactly. Yeah. They held rates steady, 3.5 to 3.75%, and the market is still trying to digest what that actually means for the rest of the year.
Right. Is the pause bullish because the Fed nailed the landing, or is it a warning that something's about to crack?
That's the hangover. It's the why behind the pause. And while we're nursing that, we're staring down the barrel of Apple's massive after-hours print tonight.
The general.
And if that wasn't enough, tomorrow morning we get the PCE data.
Personal consumption expenditure.
The ultimate vibe check for the Fed. That number is going to decide if we rally into the end of the month or if we get a rout. So what you're seeing is just huge de-risking. Nobody wants to be a hero with their position size right now.
Okay, but let's talk about the volume, because this stood out to me. Volume finished 7% above the 30-day moving average. Now, usually higher volume, I think conviction. I think people are stepping in.
And that's a classic trap in reading the tape, especially on a day like today. That volume, it's not conviction, it's churn.
It's just noise.
It's pure noise. You have to look at who is doing the driving. All the intraday data shows the HFTs, the high-frequency traders, just dominated the midday.
Ping-ponging back and forth.
Exactly, just scalping pennies. But the big money, the asset allocators, they stayed in the bunker. That extra volume was just traders hedging their bets, not planting a flag.
And we really saw that in the institutional behavior, didn't we? Especially with that green start we had this morning.
Fade the morning bounce. That was the playbook today, 100%. If you bought that open, you were underwater by lunch.
The MOC, the market on close, showed a $1.4 billion sell-side imbalance. That's a pretty significant number.
It tells you everything you need to know. The smart money used that little bit of morning optimism to trim, but you have to look at what they trimmed.
The overloved tech positions.
That's it. They're rotating out of that high multiple growth and hiding in low beta defensives. Look at the leaderboard. Utilities were number one.
Up 1.1%.
That is a pure safety trade. When the people in the corner offices get scared, they buy power companies. Meanwhile, consumer discretionary was the big laggard.
Down 0.8%. And that followed some pretty soft guidance from retail, which didn't help.
It all signals that smart money is not fully buying the soft landing story just yet. They're parking cash in boring, safe stuff until this whole AI capex cycle actually proves its ROI.
Well, speaking of that, I want to dive into two stocks that really told the story today. These outside days or key reversals. Let's start with Caterpillar.
CCAT.
The classic gap and credit. Brutal, but yeah, that's what it was. CCAT opened up 3% on a clean earnings beat. Great news. Closed down 1.2%.
This is a major, major signal. CCAT is a bellwether for the whole industrial economy. Construction, mining, global growth.
It's not just a stock.
Right. And when a company like that beats but cannot hold its gains, the market is telling you something. It's telling you the good news is already priced in. The whole industrial supercycle narrative. The market is saying, we know. What else have you got?
So total exhaustion on that narrative. And then on the other side of that coin, you have Microsoft. MSFT.
And this is the AI exhaustion story.
Microsoft tried to reclaim its 50-day moving average this morning. For a second, it looked good, but then it just hit a brick wall of selling.
It closed red for the fourth straight session. And this goes back to what I was saying about ROI. We're seeing a real shift. Investors are no longer rewarding AI potential. They're starting to punish AI spending.
And the contrast with Meta today just proves that point, doesn't it?
It's a huge divergence. Meta surged 11%. Why? Monetization. They showed they can make money from AI right now. Microsoft, on the other hand, has cratered on capex concerns. The market is screaming, show me the money, not just the GPU orders.
That divergence is really bleeding into the broader market structure.
Let's talk market breadth, because the S&P looks okay on the surface, but under the hood, it's a mess.
It's internal decay. The advanced decline ratio today was dismal. It was 1 to 3.
Wow. For every one stock up, 3 were down.
Yeah. That is ugly. That does not sound like a market sitting near all-time highs.
It certainly doesn't.
And you see it in the small caps, too. The Russell 2000, it's down 3% for the month, while the S&P is basically flat to up.
So the generals, big tech, are holding up the index while the soldiers are getting slaughtered.
The soldiers are in the trenches taking heavy fire. This whole rally has been a concentration trade. It's thin leadership. And when the generals start fighting each other, like that Meta versus Microsoft split, the other 493 stocks can't carry the load.
And we're even seeing a technical warning sign, right? A bearish divergence on the chart.
We are. The S&P hit that record, 7,002, earlier this month. But if you look at momentum, the RSI, it's making lower highs.
So price is going up, but the momentum behind it is going down. It's like a car stepping on the gas, but it's actually slowing down. It is a signature distribution phase. Institutional desks are unloading their shares into retail strength.
Okay, let's check the fear gauge. The VIX. It's just hovering near 14.2.
Which is pretty low, given everything we've just talked about.
Yeah, if the leaders are stumbling, why isn't there more panic? Why isn't the VIX spiking?
It's what we call volatility crushing. Because the Fed held rates steady yesterday, the big macro fear, the fear of a sudden rate shock, is off the table for now. So the market's just trading individual company risk, not systemic risk.
So we're comfortable. Maybe a little too comfortable.
Complacency is the real danger here. Implied vol is not pricing in a tail risk. But here's the thing. If Apple misses tonight,
the VIX wakes up.
It wakes up from its little 14-handle slumber very, very quickly. You should expect a big vol spike if Apple doesn't deliver perfection.
All right, let's shift gears. We've assessed the damage. Now let's look ahead. What's the tactical strategy for tomorrow, for Friday?
The macro view is pretty neutral. Dealers are hedged. Liquidity is thin. The statistical chance of a big directional trend tomorrow is low, only about 34%.
So we should expect that pinning behavior again.
Exactly. Market makers will try to keep prices stuck right where they can expire the most options worthless. It's Friday, end of the week. They want to kill those premiums.
But there is a line in the sand.
There is. The gamma wall. We are watching 6,215 on the SPX.
6215. Break that down for us. Why is that number so important?
Think of the gamma wall as a kind of stabilizer. It's the zero gamma flip point. As long as we're trading above 6,215, dealers are long gamma. That means when the market drops, they have to buy. When it rallies, they sell. Their own hedging suppresses volatility.
So it's a cushion. But what happens when we go below it?
Below 6,215, the physics flip completely. Dealers become short gamma. Now, if the market drops, they have to sell more to hedge. They become an accelerant to the downside. Volatility spikes.
So the strategy is pretty simple then. If 6,215 fails on the open, get out of your longs.
Don't ask questions. Just get out. The floor drops out below that number.
And if we hold it, if we open above that pivot point,
then there is a fantastic asymmetric trade on the table, a Friday gamma squeeze. You look for long SPX call spreads targeting 6,275.
And why does that work specifically on a Friday?
It's the options expiration. If we're above that pivot, dealers have to buy back their hedges as those weekly options decay into the close. And with Friday's time decay, theta, working for you, the options are cheap. A small move in the S&P could mean a huge return on those premiums.
Low risk, high reward. I like it. Let's get to some day two stock setups. First, NVIDIA.
NVDA. Today was a high volume breakout above $165.
It felt strong. Felt like the old NVIDIA for a minute there.
It did. And crucially, we saw institutional dark pool accumulation in the final 30 minutes of trading.
Dark pools, the private exchanges where the big guys trade so they don't tip their hand.
Exactly. And seeing them buying heavily right at the close means the big money thinks there's more to come tomorrow.
So do we chase it at the open? Bite the bell.
No, never chase. That's how you get hurt. You look for the retest. Breakouts almost always come back to check that breakout level. So you look for an entry on a dip, maybe to 164.50. Let the price come to you.
Discipline. Okay, you have one more. Helios Energy, ticker HLS.
Yeah, this is a classic technical setup. It had a failed breakdown today. It looked like it was about to crash, but it reversed hard and closed back inside its 20-day moving average.
Meaning the shorts got trapped.
They got caught with their hand right in the cookie jar. They piled in short thinking it was breaking down, and now they're all underwater.
The play here is simple. You go long on a break of today's high. That's $88.20.
You're betting on a short squeeze.
It's a forced cover rally. The shorts have to buy to close their positions, and that buying is the fuel that sends the stock higher. We just want to ride that wave.
Okay, before we sign off, final directive for tomorrow morning. Apple's numbers will be out. PCE data is dropping. What's the one thing we need to remember? Two things. First, if Apple misses, forget everything I said about the upside. Forget the gamma squeeze.
What's the level to watch then?
You watch the 7,150 floor on the S&P 500. That 7,000 area is a huge psychological level for the first half of this year. If we lose 7,150, things get ugly fast.
And for the opening bell itself.
Do not chase the open. The first 30 minutes are what I call amateur hour. It's all emotion and overnight orders. You wait for the 10:30 a.m. liquidity sweep.
When the pros step in and set the real trend for the day.
Exactly. Let the market show you its hand before you put your capital at risk.
Discipline is the name of the game. We will be watching. See you at the bell.